Investors inside our community have analyzed over 1,600 stocks in the past month, and we're going to analyze the top 5 right now. First one, Nike. Nike is absolutely killing it with its global reach, and North America is leading that charge. In the third quarter of 2024, the North American region brought in a solid $5.07 billion, making a 3% year-over-year increase. Now, it doesn't sound like a lot, but for their new plans, that is a lot. Now, 3%, again, doesn't sound like a powerhouse, doesn't sound like a lot of growth, but you gotta remember, Nike's pulling back the reins on how much they're sending out to stores. Their goal is to do more direct to consumer, which is also higher margin. Because before, if you sold to a store, you gotta give the store enough room for profit. Now they're selling directly to consumers, they're giving consumers a lot more options, and they're keeping a bigger chunk of the profit. But that isn't all. Nike is putting the pedal to the metal in Greater China, where footwear revenue shot up 5% to $1.5 billion in Q3. The company's performance in China shows its resilience and strategic focus on these emerging markets as other markets around the world get larger and larger, and total revenue grew by over 4%. On top of that, Nike is pushing hard on its digital transformation that I was discussing before, focusing on their direct-to-consumer sales to boost those margins and enhance the e-commerce presence. Everything is about e-commerce these days. These moves are definitely positioning the company for long-term growth, making Nike a stock worth watching. Nike is a stock that I own. Now remember, don't buy Nike just because I have it or anybody else on the internet or even Warren Buffett has it. In fact, Bill Ackman just increased his Nike holdings by almost 500% this last quarter in his 13F. That's a big jump. Now you might be wondering, Paul, Nike, what's going on with Nike that makes it so attractive? Well, first off, it's Nike. It's the global leader in apparel and shoes. Anybody who thinks otherwise, I just ask you, how long have you been working on Under Armour? How long have you been working at Adidas? Because the only other people in the world who would think that would be working at a competitor. Nike is a brand, Nike is a moat. And most importantly, their stock is down under $75 right now. Their all-time high was $180 3 years ago this month. That's a long time. And back then, I guarantee if we did videos on Nike, people would have said, Nike's never going to be below 100, blah, 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 blah. Well, look at it now. It just goes to show that even the most amazing companies like Nike can see a fall at some point. Just have a shift in the mood. Now, the reason our community members are looking at the stock is exactly this. I always tell people, a great place to look, to start looking for a company to buy, is one that's fallen precipitously. 175, 180 down to $75, over a 50% drop for a company like Nike. You got to take a look at it. Absolutely have to. Now, the company has a $112 billion market cap. Its last year's free cash flow, $7.2 billion, beating its net income of $5.3. Its margin is still at the same consistent 5-year level, 10.6%. But I think that's going to go higher along with this gross margin of 45%. Now, gross margin, as you know, or if you don't know, is the amount of money they make on every additional dollar they bring in revenue. It goes before the overhead, before taxes, all that stuff. That's pretty solid. If this is a high number, it means they can grow their profit very quickly as they expand. So guys, let's look at the 8 pillars here. And what's the story that Nike is telling us with these 8 pillars? Guys, everything's a check except for valuation. Now, with moat businesses and businesses with a high return on capital, these are the businesses who can get a high return on the money that's invested in the business. You should be willing to pay a premium for that. So even though these are X's, I don't know if that's really an X. Is it reasonable to pay 20 or 25 times earnings for a brand like Nike? That is your decision to make. That's what makes investing so great. That's probably why so many people in our community are running Nike in our stock analyzer. Because the stock analyzer is exactly used for the reason of making 3 assumptions on revenue growth, profit margin, everything to determine the right price to pay for the company. So let's see what happened with Nike the last time I put it in my stock analyzer tool. What were my assumptions here? So I did 3, 5, and 7% revenue growth. Pretty reasonable, if you ask me. Profit margin, I did 10, 11, and 12, same with free cash flow. Now again, guys, I do think their profit margin can get better, so I think I'm being reasonable here. PE, I did 20, 23, and 26. Remember what I said before. I think they're a premium business that deserves a premium to them. Their 1-year price to free cash flow, currently the trailing 12 months is 16. That one in the 8 pillars was the 5-year free cash flow. And finally, I put a 9% desired return. Now, if you look at community members, they're not putting in 9%, and they shouldn't, and you shouldn't either. I select 9% to give me the intrinsic value of the business. What's the business worth today? Because the market's going to do 9 or 10%. So if this were to match the market, what's that worth? But remember, you're buying an individual company. You should have a margin of safety. So the number here should go higher when you do it in your own stock analyzer analysis. So we hit the analyze button, scroll. We get a low price of 60, high price of 120, middle price of 85. Based on today's price, almost an 11% return, including dividends on this company. So in my opinion, I've started buying some. I have puts at lower prices, and the lower and lower it goes, more likely I'm going to buy it. Remember, news follows the stock price. So I'm sure there's a lot of news out there that's negative about Nike. Stock number 2, Crocs. I was actually surprised about this one. Crocs is straight up killing it, and the numbers back it up. In 2023, they pulled in a record $3.6 billion in revenue, a 54% boost from the previous year, all thanks to demand for their classic shoes and the recent Hey Dude brand acquisition. Now, the good news is the brand isn't just sitting pretty. They're aggressively expanding, aiming for 10 to 13% revenue growth this year alone. International sales are a major driver, especially in the European, Middle Eastern, and Asia region, where sales exploded by 49.2%. And it isn't stopping there. Crocs is doubling down in e-commerce with a 19.6% jump in online sales. With these moves, it's absolutely clear that Crocs is able to scale and able to scale like a beast. And with growth in both international markets and digital sales, it's looking like a no-brainer for some investors if the price is right. Now, the stock here also had an all-time high back in 2021, just like Nike, right around the same time of 183, exactly 3 years ago, basically. Got as low as $85 back in January of this year. It's currently at $97 per share. Now, some benefits of Crocs. Price to free cash flow, 6. They generated almost $1 billion in free cash flow last year versus $834 million in net income. And their 5-year free cash flow is $536, which is 11 times free cash flow with a high return on invested capital. Guys, that's impressive. Those are really, really good numbers. The question is the growth going to be there? Well, let's go see what the 8 pillars say before we get into the growth story. 8 pillars, 8-pillar thriller, guys. Everything is check marks. Everything. Guys, I love the fact they're buying back shares, and I hope they continue to buy back shares. I love that they don't pay a dividend. Now, I get worried. When companies' stock starts to falter, they start to worry about paying a dividend to get people attracted into it. I want them taking all their cash and buying back shares at these low multiples. That would be the best thing to do with the extra cash flow for the company. They can't use it to expand at a profitable rate. Everything else is a check mark. All right, so let's see what analysts say about Crocs' revenue growth potential. Not huge. 4%, 5.5%, 3%, 14.8%, 7.8%, from $4.2 billion to $5.6. So, Hey Dude's very popular. I know a lot of people who have them. They have said, though, recently that Hey Dude's sales growth has slowed down. And the Crocs by themselves, guys, they're fun now. They've got all those little giblets you can put on them. People love using them for outside work, inside work, a lot of restaurants. It's a great product that's very simple. So the question is it going away? Well, that's the determination you have to make. It looks like the market's pricing in it's going away based on 6 times free cash flow. All right. I made some pretty conservative assumptions here, guys. I did 0, 3, and 6% revenue growth. By the way, guys, increasing return on invested capital. That's a major check mark to this business. All right, 17, 20, and 23% profit margin and free cash flow margin. Not bad. PE, I did 13, 16, and 19. You know, the hard part is for me, we might wake up 10 or 15 years from now and go, Crocs is a brand that's going to be here forever. But we don't know that right now. They've been around for a long time, but they've only recently become more and more popular. But if they do a great job of this free cash flow, expanding their lines and buying back shares, this could be a company that's like AutoZone or like NVR that just buybacks a ton of shares and gives amazing value to its investors. This one's very interesting even to me. So then I have my desired return of 9%. Hit the analyze button. Guys, this is pretty interesting. 133 on the low side, 350 on the high side, 220 in the middle. A potential 22% return. This is exactly why it's getting the attention of those in our community. Stock number 3, Celsius. Guys, ignore the stock chart on Celsius. It is down big time, and the story doesn't match the stock price. All-time high of $99 just earlier this year, a mere 8 months ago, hit as low as $25.23. It's currently, and that was actually just today, hit a 52-week low just today. That's a big fall. But remember, you have to look at the difference between the business and the stock price. Celsius as a company is on fire, hitting $2.2 billion in revenue for 2023, making it a 15% year-over-year jump, thanks to its growing fan base and surging demand for its calorie-burning drinks. The future actually looks even brighter, with analysts predicting 6 to 8% market share by 2025, driven by a key partnership with PepsiCo and a bigger global footprint. Now, with these solid financials and focusing more on the marketing push, Celsius is positioned for even more growth, making it a compelling investment for the long haul, along with this happening. That really, really helps a ton when it comes to looking at a company and saying, let me pay attention. Guys, these are the things we discuss every single day in our community. This is exactly why you have to sit there and use all this community and the tools to get better at making decisions. Now, today's software that we have does include everything that has to do with stocks, retirement, and real estate and all these tools, but behind the scenes, we're making some changes. That offer is going to go away very soon. If you've been around since the beginning, I built this software selfishly for myself as an Excel sheet, but so many people out there kept saying, how do I get your software? How do I get your software? So it just said to us, listen, let's go make the software for people. So we made it for everyone, but we mostly made it for ourselves to use it internally so we can keep making better investments in stocks and real estate. In fact, I recently bought a 200-unit apartment building for over $20 million and a 40-unit apartment building for $7.5 million using this retirement real estate calculator right here. This alone. Now, as we've grown, it has to become less about me and more about how I can better serve you and the people in the community. And this is why we update our software regularly to give you exactly what you need, including recently a new St. Louis Fed series where we're pulling in economic data that's just going to grow like crazy. Now, the good news is all these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with everything because this is the best deal we've ever offered. And I'm telling you this now because there is still time for you to sign up. As long as you join the Everything Money community before we make the changes, you can keep your plan even after the changes are made and you keep all these tools forever. And more importantly, you stay in your pricing tier forever. So click on the link in the description below to get access to everything we have to offer, including all of our investing tools and the community. And I'm very confident it'll be the best investing decisions you've made all year. Now with Celsius, let's see if this will be an even better investing decision. Here's what I love. $6 billion market cap, $5.6 billion enterprise value. That means they have net cash on hand. Because usually most companies have a higher enterprise value, which means there's debt in the company. When the enterprise value is lower, it means you can buy the company, use all the cash to pay off all the debt, and still end up with cash left over. That's what's incredible. All right? Now the profit margin. This is interesting. 5-year average profit margin is 6%. Last year's profit margin, 15.6%. Now the question to ask is, are they becoming more efficient? Is that why there's a 15.6% profit margin versus 6% historical? Is it some other reason? These are important questions to ask. All right. Now, let's go check out the 8 pillars. All right. Not as rosy, but remember, we don't buy or sell based on 8 pillars. It's about telling us a story. What's the story here? Well, the return on capital is low. 5-year return on capital is 1%. But guys, the 1 year is 15%. So they might be turning a leaf over here, which means maybe ignore this one. Shares outstanding up 4%. Okay, not bad. Now the 5-year PE and 5-year price of free cash flow, very, very high. And it's not like their profit. So if you look at their net income here, 5-year average is 43 million, net income of 200 million last year. Free cash flow, 5-year average is 60 million, 170 last year. So it's still elevated. It's not really 100 because they're a growing company, but it's still elevated for recent times, for their recent data. I mean, even if you triple this, take 1/3 off, it's still 50 and 33, which is still rich. But if they're growing like crazy, it might be okay. Remember, you should be okay paying a premium for good growing companies. You absolutely need to pay a premium for that. Is Celsius that one? I don't know. That's the question we have to ask ourselves. So let's see what analysts are saying for their revenue growth. 20%, 18%, 19%, 35%, 8.5%. But here, not many analysts here, only 3. But that's it's a lot of growth. That's going to double in the next 4 years. 1, 2, 3, 4. Doubling in the next 4 years. That's a pretty fast growth rate. So even if they double their profit, is 4 years enough time? Maybe it is. This is something that with its fall of 75% is something worth looking at. Now, if you make the decision to buy, in all likelihood, it's probably going to go lower. You're not going to buy at the bottom. So you have to be okay with that. That's very important. So let's go pull up Stock Analyzer and the Celsius story. So I did 10-year analysis, 4, 8, and 12% revenue growth. Profit margin, I did 12, 15, and 18. Same with free cash flow. Now for PE and price of free cash flow, I put 15, 17, and 19. I kind of want to go lower. I kind of want to go, it's hard because let's do 13, 16, and 19 because it's still an energy drink and a lot of energy drinks. There's so many of them out there. But for those of you out there, apply a reasonable PE and put the margin of safety much higher. I'm putting in my 9% here. Hit the analyze button. I have a low price of 11, high price of 37, middle price of 20. So for me, guys, I understand why it's getting a lot of attention in the community because it's down 75%. But I look at this going, maybe it's not down enough. Maybe, remember, just because something's down 75% does not make it a great deal. Stock number 4, another stock that I own, PayPal. Venmo makes up 18% of total payment volumes in Q3 2024. And the reason that matters is who owns Venmo? PayPal. Guys, ready for the stat? 24% of the US population uses Venmo today. That's 83 million people. And not only that, it's estimated they're going to grow mid to high single digits through 2027. And the majority of Venmo users are in the range of 19 to 49 years of age, which is the highest consumption phase of life. Guys, Venmo is a verb. Literally, can I Venmo you? Venmo me. I've literally hired people to do work for me around my house where I say, do you have Venmo? No, get Venmo. And the interesting part is, even though the app is absolutely dominant, it hasn't even come close to full monetization. But this is changing. As management announced in Q3 of this year that they're going to begin monetizing the app to do this. They're rolling out debit cards and pay with Venmo online payment checkout features, which I think is fabulous. I love using Venmo. Look at this. Venmo processed $276 billion in total payment volume in 2023, a 13.1% increase year over year. Here's another interesting stat. Look at this. Year-on-year percentage change and total payment volume. Look at this. Boom. Growing payment volume. Now, obviously the growth rate slowed because the app is not as big, but this is still right here, 6 to 10% annual growth. Guys, Venmo's huge. Allows people to do amazing things. You can pay somebody, boom, just like that. Here are some other amazing statements about PayPal. 426 million active users. Guys, there's 8 billion people in the world. That's 5% of them. Total payment volume reached 1.53 trillion in Q4 2023 across 25 billion transactions. Guys, in 2014, it was 250 billion. In 2018, it was 500 billion. Look at this growth. That's amazing, amazing growth. And the more online grows, the better this will do. Up to 36 million merchants use PayPal in over 165 countries worldwide. And guys, 60% of consumers trust PayPal more than their bank for storing payment credentials. Trust is everything when it comes to money. PayPal has that trust. That's what's important there. So guys, here are the 8 pillars on PayPal. Guys, as you can tell, their free cash flow is better than their earnings. And you see that right here. Free cash flow of $7 billion, net income of 4.43, 5-year free cash flow of $5 billion versus 3.71. So they're going to have a lower price of free cash flow than their earnings, which I love. Everything else is a check. They're buying back shares, and this is especially important for a company that went from an all-time high of 310 down to 55 in the last year. About a year ago, it was down to $55 per share. A lot of people saying the company is dying, as we said earlier. But I look at the numbers going, yes, there are issues. The question is, has the price drop over-exaggerated those issues that are coming? So let's see what analysts think about the potential for PayPal. Okay, $4.50 per share in earnings this year, growing to nearly $7 here in the next 4 years. Not bad, decent growth. And revenue, boy, isn't that funny? 8%, 8%, 7.5%, 8%, 10.5%. Pretty solid for a company that is supposedly declining. Again, analysts could be wrong. I agree. I always say that. You've got to be cautious. But the reason why I continue to hold PayPal, I think you'll see in 2 seconds when we do our stock analyzer tool on PayPal. Let's pull it up right here. The Pay Pizzle. Okay, I did 4, 7, and 10% revenue growth for PayPal. I did a profit margin of 12.5, 14.5, and 16.5. And I went higher with the free cash flow, and I'm going to focus on free cash flow here because that's the metric I want doing better. I did 16, 20, and 24%. All right, PE. I did 14, 17, and 20. Now, I did a lower one down here, even though their ROIC is increasing. There's still a lot of competition in this area. So I'm going to put that lower PE, and I did my 9% desired return. Hit the analyze button. Guys, a low price of 61 to 78, high price of 160 to 230, middle price of 100 to 140, and paying today's price, assuming all my middle assumptions are correct, I'm looking at a 16% discounted cash flow return. That's pretty solid. Now, does that mean I'm going to be right on this? Not necessarily, but I think this is enough margin of safety for me, where even if I'm wrong, I might still be able to squeak out a pretty decent gain for being wrong on a company, and that's really what we're talking about here. Our fifth stock, Dollar General. Guys, look at Dollar General. Year to date, down 45%. Last 6 months, same thing. Last 3 months, 37% down. That's a huge drop for a company that is supposed to do better when the consumer gets weaker. So who knows if that's happening? Now, they are on fire this year with a clear strategy to capture new, higher income customers. That might make you laugh, but it's actually true. The average household income of their shopper has jumped from $40,000 to almost $75,000. The company's expansion plans are also on another level, with a plan to open 2,300 new projects in fiscal 2024, including store remodels and international growth with pop shelf locations and Mi Super Dollar General stores in Mexico. But that's not all. Dollar General is also making smart moves to boost its efficiency, investing $150 million in labor to improve their customer service and inventory management. Their plans are to maintain a 6% operating margin, but with a goal to return to its historical levels of 8%. They are definitely setting themselves up for driving that bottom line long-term growth. So let's take a look at this. Dollar General, big difference between market cap and enterprise value. Probably a lot of those leases in there. Guys, the ROIC is not as high as I'd expect for a company like this, but look at this price to free cash flow, 10. 5-year price to free cash flow, 11.5. They pay out a lot in dividends here. 3% dividend yield is probably grabbing a lot of attention. And a big part of that is probably driven by the fact that their all-time high was $260 a mere 2.5 years ago, and it recently hit a low of $73 just last week. That's a big difference, which is probably why this dividend yield is so high. When it was back at $260, it's essentially a 1% dividend yield. So this is how you ride those dividend yields to get higher numbers. And the good news is this dividend of $500 million, they're safe on that one. The last 5 years, they've done $1.5 billion in free cash flow. They can easily afford this dividend any way they cut it. I am surprised about this 30% gross margin, and this 5-year profit margin of 6% has been hit in the last year at 3.6%. So guys, these numbers are good, not insanely awesome, but they're good. And for a company that's down 75%, it's something to take a look at. Now let's see what these 8 pillars are telling us. Okay, we have a few issues here. Here's what's interesting. Revenue growth up $8.5 billion, yet net income is down almost $1 billion, and free cash flow is down $1.5 billion. So I want to understand why that is. I can understand free cash flow if there's capital expenditure growth. So let's go look at our CapEx here real quick and see if there was a big surge in capital expenditures by going to our cash flow statement. Scrolling a little bit down here, the first line of the investing section, $1.7 billion. Yeah, big jump, $1 billion in free cash flow, in capital expenditure increase. And here's the thing, that $1 billion increase was not met with cash from operations increase. We're talking about barely an increase. And so that's the big driver of why their free cash flow is lower, is their capital expenditures. The question is this reasonable? Is it good for them? Are they going to invest this money to get that growth that the company needs? Don't punish a company that's investing in itself if the investing is smart, because there's definitely an increase here. Just like it was an increase from 2015 to 2019. These are the questions that you have to ask, and these are the reasons why having this kind of software is important, because you see this change immediately, and you go, wait a second, how does this company increased their revenue by $8.5 billion and they decreased their cash flow by $1.5 billion? You have to ask those questions. And those are the things that a lot of average people are never going to know. That's why you're above average by being here. So let's see what the analysts are saying about Dollar General. All right, 770 EPS to 1216. Pretty decent growth. A couple decreases here, but then back to growth here in future years, according to the analysts. And guys, at $12, that's basically 6 to 7 times the stock price right now. But look at this revenue growth. Pretty consistent. 6%, 5.5, 5.5, 6.5, 6.5. All right. So with inflation, cost of living going up, their revenue is going to grow, but also with growing their stores and making more stores and making their other stores more efficient, that can really help their revenue growth. So the question becomes, our final question, stock analyzer tool, what is Dollar General worth to us? So I did a 10-year analysis, 3, 5, and 7% revenue growth. I did 5.5, 6.25, and 7% profit margin. Their free cash flow is lower, but it seems like they're investing a lot in the company, so it could be okay. And I did 13, 15, and 17 times earnings. They're currently selling for 12 and 10 times their earnings and a 9% desired return. Hit the analyze button, and guys, don't forget, $7 for 7 days. Click that link below to try out our software. Wow, this might be interesting. 100 to 140, 210 to 290, 150 to 200 in the middle, with a potential return of 20% per year if the middle assumptions occur. That includes the dividend. So if you want to see our latest video on our stocks at a 52-week low, watch this next video. Thank you very much for your time.